Afternoon. Welcome to the Bull Bear debate on Car Auction Services, Inc., led by Ben Claremon and Robert Longnecker.
Thanks for having us. We're excited to be here. Thanks to the Investor Summit for allowing us to have this Bull Bear discussion. So the topic of the day that Rob and I are going to discuss is Car Auction Services, ticker CAR. We're going to be kind of alternating between slides. So hopefully it's not too awkward, but we're going to go back and forth and hopefully have an insightful, enlightening conversation on CAR. Just a safe harbor. The opinions expressed herein are those of Cove Street and Ides and are subject to change without notice. You should know that this is not an offer to buy or sell securities. And also, we should disclose that both Ides Capital and Cove Street Capital are currently CAR shareholders.
Hey, Rob Longnecker. Really happy to be here. This is what the layout of the format's going to be. As Ben said, it's a bull bear. Ben and I bounce ideas back and forth pretty frequently, and a lot of times we have a point-counterpoint approach, and this formalizes it a little bit. So we're going to go through our bios, we're going to go an overview on the stock, and then we're going to lay out a bunch of point and counterpoint slides, and then we'll open it up to Q&A. So again, I'm Rob Longnecker. I'm co-founder and director of research at Ides Capital. We've invested in mid-cap stocks. We take long-term positions in quality companies, and we typically work with management and the board to improve those companies in a variety of ways.
I'm Ben Claremon. I'm a portfolio manager at Cove Street Capital. Cove Street's a small and mid-cap focused firm located in LA. Let's see what else. We take a 3 to 5 year time horizon, concentrated portfolios, think 25 stocks or fewer. And I am also the host of a new podcast called Compounders, The Anatomy of a Multi-Bagger.
So kind of a brief overview of CAR. It's a $2.2 billion market cap company. They are the second largest, their Odessa segment is the second largest provider of physical auction services in the United States. Their primary competitor is Manheim, which is owned by Cox. Between the two of them, they have a 70% share in that market. They are growing in the dealer-to-dealer space. They're growing in the digital online space, predominantly through their acquisition of Backlot Cars in 2020. They also earn a lot of money in their finance subsidiary, which is called AFC. And some of you, if this is familiar to some of you, you may remember that a couple of years ago, CAR spun off their subsidiary called IAA, and that's now a public, separate, standalone company.
I'm going to go over the used car market overall, just because it is a very large market, and there are a lot of different dealers and there are a lot of different players within this ecosystem. And one of the most difficult things about CAR, as looking at it on the long or the short side, is understanding that ecosystem and the desires and needs of each of the individual players. So if you just think about the used car market overall, it's about 40 million used cars sold every year. And the dealers sell 29 million of those cars to consumers, and the rest are sold kind of consumer to consumer. So if you think like eBay, right? Like if you're selling your car on eBay, that would be consumer. So but the question is, where do the cars come from that are within the wholesale market, where like dealers are selling them between each other? Like that's a subsegment, because all of the dealers and other outlets where cars are sold, these cars need to be sourced from somewhere. And so we're talking about a dealer wholesale market that's about 14 million units. And then there's a commercial wholesale market where, if you think it's like Toyota Financial or an insurance company or a fleet, like the Hertz rental car fleet will be selling cars. So that market's about 22 million cars. Used car dealers source their inventory through a number of ways. So first you have trade-ins from consumers. The other way is you can buy other cars from dealers via both digital and physical auctions, which is where CAR is playing in both, but traditionally has been in the more physical auction space. And then dealers can buy from commercial sellers, as I mentioned, off lease, repos, rental car fleets, and those are typically via physical auctions.
And one thing I would just add on the previous slide, and I think something that drew Ben and I separately to this stock is that 40 million a year of used car sales is a very stable number. It's not that tied to economic cycles. It's not that tied to the new car production cycles. It's just tied to the size of the car park in the United States and how many vehicles are out there. So they're transacting every year, no matter what's going on in the economy. And that's been generally very stable and very interesting, I think, to both of us. So why are we here? We both own the stock. We've had a fair amount of discussions back and forth on pros and cons and risks and opportunities. And this is basically a battleground stock. It's somewhat difficult to understand. There's a lot of moving pieces going on inside the business. You've got the incumbents, you've got upstarts, you've got physical auctions where basically people literally bring their vehicles to a physical location and they get auctioned. And then you've got sort of the upcoming digital where everything's done online and, you know, on your phone or on a computer. So, you know, there's the tension there. There's a new public company called ACV Auctions, ticker ACVA, which has, you know, recently gone public. They are generating a lot of growth, doing digital only. They're also losing a lot of money, but they're growing and they're taking share. And I think people view them as a risk, a threat, and they are. And then there's in the backdrop of all this is that generally stable used car market is in a period of extremely unusual uncertainty and strength because of COVID, because of the chip shortages, people not wanting to sell their cars, not wanting to walk into dealerships, and then the OEMs not able to manufacture sufficient new car vehicles. There's extreme demand for used cars right now, and used car prices have been trading at premiums to historical levels that have never really been seen before. And just sort of as an anecdotal evidence, I own a 2018 Mazda, and I was speaking to a fleet manager at a rental car company recently, and he told me he would buy that vehicle from me for what I bought it 2 years ago, which is obviously extremely unusual and adds more to the confusion of understanding this story. Car is in the middle of a digital transformation. They are responding to the threats posed by ACV, and that's something we'll get into in this presentation. But as the last bullet point says, this is a battleground stock. It's easy to make strong arguments for the long side and the short side, and only time will tell who's right.
So I'm going to start as the resident bear with the bear case, and I think this is the one that the market perceives to be the most salient for car, and it's that D2D transactions, so dealer-dealer transactions, will replace physical auctions. And so there's an ACV. If you read their calls, you'll find a very articulate case for why the going to physical auctions is somewhat inefficient. So typically, physical auctions are only held once a week. So, you know, if you're in LA and you want to go either buy or sell a car and you're a dealer, you have to wait till next Tuesday to do so, right? Like if you get a car on Wednesday, you're going to have to wait until the next Tuesday to sell it. And so, you know, what other market is only open once a week? That doesn't make a whole lot of sense. Secondly, the employees have to physically leave the dealership and drive to auctions. And so there's a time cost. That person could be doing a lot of other things other than, you know, could be selling physical cars, could be buying cars from other dealers. There's a lot of other things people could be doing, and there's only 24 hours in the day. So why in the world do you want to drive an hour or more to go to an auction? And so that, you know, that it is a time saver if you don't go to the physical auction and you sell, you know, kind of via an app or through the computer. The other thing is that, you know, if you're online, the inventory is literally unlimited, right? You can source cars from miles and miles away. You know, it doesn't have to be just in your market, and it's not constrained by the amount of land that's available at the physical site. So if you're at a physical auction and the auction that site can hold 1,000 cars, that's the total inventory. But if you're online, you could probably see thousands of cars. I mean, maybe one's couple hundred miles away, maybe one's 1,000 miles away, but with transportation costs as have been coming down, somewhat subsidized by the incumbents and ACV, you can source cars from further away at a reasonable cost and never even have to leave the office. And so why wouldn't you forego going to the physical auction, go on ACV or Backlot, which is owned by Car, and do all of this from your desk? The other big reason is that auction fees are higher than dealer fees. And so in addition to it being more inefficient to go to the auction, you're also taking home less when you sell at an auction in a lot of cases. And so the takeaway here is that as volume shifts, as a dealer has an incremental car and can either take it to an auction or put it on a website and sell it from his or her lot, that volume will shift away from auctions to D2D. And as a result, the revenue and margins at car are going to be hurt. And so even if backlot and trade rev, which are their dealer to dealer platforms, even if they win, the real estate becomes unproductive, and all of a sudden you have a big fixed cost infrastructure that they're not able to leverage.
Yeah, I mean, there's obviously truth to a lot of those points or possibilities, but the reality in the world of retail these days is that omnichannel is the model, and you can see that in tons of online-only retailers that are now opening stores. They understand they need to offer both to their consumers, and just like in the used car market, not everything is suitable to be sold online. Some people want to come in and kick the tires. Some people, for example, we can see in the second bullet point, rental car fleets and captive finance companies and people doing repossessions. Those people are potentially selling thousands of cars at a time. And that's where a physical auction really shines, particularly if those are cars that need to be removed from where they are. If you're an urban rental car company, you can't hold 100 cars on your lot at LAX while you're waiting to sell them online. You got to get those off the lot. So they need to go somewhere, and physical auction can serve there. Physical auctions can also serve to recondition those vehicles. So there's always a place for physical auctions. What the model that Car is creating is, with the acquisition of backlot and with the acquisition of trade rev, is we'll offer a digital channel, but simultaneously we can offer a physical channel. And if it doesn't sell in digital, we've got an alternative for you on physical. And a lot of times, and this is also, again, being skewed by this very strange used car market, we're seeing that supply is very, very short. So it's extremely easy to sell a used vehicle of any age, any quality, any mileage. They're just getting snapped up left and right. In a more realistic model, a lot of those cars are not suitable for being sold online, and they're going to end up at auction, it is the lower quality cars. And it is the cars that need to be, that are harder to sell, and auction is the place for that. And I touched on above that urban versus suburban matters. These auctions in big urban centers, these physical auctions, are always going to exist because the people who have vehicles in those areas need to move them off their lots and have them go somewhere else to be sold. And ultimately, if, to Ben's point, if some of the auctions become non-economic, Car can close those and they can sell the land, which will be extremely valuable. One final point, when Ben talked about margins and volumes, there is a real possibility that margins are under pressure. Car has already been responding to that by taking a lot of money out of their SG&A and their cost structure. And that's starting to show up in the earnings as well. And I think it's going to be extremely powerful a year or two down the road when they've got a lower cost structure and volumes and revenues kind of normalize. I think we'll see that hit the P&L in a great way. So I think there's a lot of counterpoints to that digital is the only way argument.
Those are great points. And the underlying assumption there is that Car will be able to offer technology that will be easy for dealers to use, and they will be able to compete in a very technology driven world. And so the bear case is that that's just not the case, because they're not a tech first player like ACV or Carvana or CarOffer, which is now partly owned by Car Gurus. The case in point here is that if you look at ACV was like founded like 4 or 5 years ago, and has been just absolutely eating Car's lunch in D2D for two or more years. And the reason is because they were made to be a digital company and not a physical auction, and they've just been able to be much more nimble as well. So the truth of the matter is that Car has a good incumbent position in the physical auctions, and they've bought technology, but culture change is really hard. And that means a lot of things. One, do you really have the first class technology people who can help build your D2D business? Do you have the salespeople who really understand digital and who haven't been there for 20 years trying to sell cars through a physical auction? So that can take time, and the evidence has suggested that ACV has been winning during that, as Car is trying to transition to that. You know, case in point, Car has all of these brands, and if you go through their filings, you'll see there's ADESA, there's Open Lane, there's Backlot, there's Trade Rev in Canada. And I'm probably missing 7 other brands. And so if you were starting this from scratch, you would have a single portal where someone could come in and log on to Car, and they could see digital inventory, they could see physical inventory, and it would be one login, and they're not even there yet. I mean, like, and ease of use is really important, and that, I think, that's where ACV has been winning. And the other thing is that Car has cobbled together different systems, whether it was Trade Rev, and now they're layering on Backlot, and they're trying to integrate Open Lane with all of that. You know, built from scratch and digitally native is just better, because integrating different systems is always hard. And so the truth of the matter is that, you know, how many companies have you seen really be able to disrupt themselves? And a company that started in physical auctions is really unlikely to disrupt the legacy business model, because there are too many mouths to feed within the physical auctions. And the question about culture continues. Like, can they be adaptable and fast moving enough as the dealer to dealer market really evolves? So my takeaway here is that even if D2D is a huge opportunity for Car, while they may have the assets now to do so, you know, they're behind, and they need to have to simultaneously have a culture and technological change within a dynamic market. And in the meantime, their competitors are just going to continue to build share and build scale and take share.
Yeah, I think this is sort of the cornerstone argument in this bull bear case is, you know, is ACV going to come along and just absolutely destroy this business, and this business is going to become worthless? And it's sort of like what everyone says, you know, was Amazon was going to destroy Walmart, Amazon was going to destroy Target. I mean, obviously there are businesses that Amazon have destroyed, but capable competitors have been able to respond and offer a competing product. And that's what's happening here. Yes, ACV has had a very strong start. They've been growing rapidly. With their growth have been large losses, which at some point, presumably their shareholders are going to expect some degree of profitability. I don't know when that occurs, but you know, they're burning cash right now. Cars, I would say initial responses in digital were not ideal. They bought Trade Rev, they spent a bunch of money on it. They lost a bunch of money for a couple of years. That wasn't working out for them. Then they bought Backlot because they knew Trade Rev wasn't working out. They spent, I think, $425 million on Backlot. That was a lot of money, but it was the right thing to do. Backlot, there's no difference effectively between Backlot and ACV. ACV doesn't have any special sauce. They'll try to claim they do, but the technology is similar. The process is similar for the dealers. It's literally who can get out to the dealers and convince them to use their product. And again, that goes back to where, you know, if Car is offering something that's equivalent to Backlot, equivalent to ACV, and they have the physical auctions, and they've already got the dealer connections, there's no reason why they shouldn't be a real competitor here. And I think was demonstrated most expressly when they named the new CEO. They brought Peter Kelly in, and I guess March 2020. So pardon me, March 2021, and said, "This is our guy." And Peter comes from a technology background. He was the CEO of Open Lane, which is an online platform that he sold to Car years ago. So there's no clear indication that Car's board and management is taking this threat seriously by who they just named to be CEO. And he knows what needs to be done here, and he's done it before with his previous company. So I think he's a great person to lead Car from this point going forward. As Ben points out, we've talked about this dealer to dealer market. Maybe it's 15 million cars, maybe it's 10 million cars, maybe it's 5 million. It's a little bit unclear. But the point is, those are cars that ADESA never got to touch anyway. So there's a lot of open ground there for them to pick up share in those cars. And just to put that in context, in an average year, Car sells 3-4 million vehicles at auction. So you can see that, call it 5, call it 10, call it 15 million vehicles that they're battling ACV over. It's a real kind of opportunity there, and it's large and it's meaningful, and could drive an enormous amount of earnings and profitability if they get their fair share there. So yeah, I think that's about it. The last point, the takeaway, the earnings power are now much higher. That is because they've taken costs out of the system. Now volumes need to come back because they haven't, for all the reasons we talked about before. Volumes have been below previous levels. But if they come back to 2018, 2019 levels, this is a company that mints cash. So they've got a market cap of $2 billion. In the years before COVID, they were returning $300 million a year in capital to shareholders. In the first 6 months of 2021, they've returned nearly $200 million of capital to shareholders. They generate a ton of cash, and there will be some pressure on that from the ACB threat. But I don't. This is not like a melting iceberg. You know, maybe they're going to lose a little bit off the top, but they're taking it seriously and they're competing well.
Those are good points. I mean, there's. I mean, again, as Rob said, this is the crux of the argument. It's like what happens with D2D. But I'm going to just point out one thing that you know, I think you also have to run a good business, and you also have to own a good business, and you have to have a moat around that business. And you know, the truth of the matter is one of the things we've learned is that running physical auctions is not that great a business. You know, so what happened is, as we talked about, Rob talked about at the beginning, is that CAR spun off IAA in 2019, and that gave people like a much better sense of what the margins at ADESA, the physical auction side, really looks like. So ADESA absorbed all of the corporate costs, and margins went way down. So if you looked at this pre the IAA spin, they had a corporate line, and then they had individual segment margins, and it looked like the ADESA business had a 20% EBITDA margin. That is not true anymore. That's more down like 10 to 12%. So you have a kind of capital intensive business that has a lot of physical assets that's not generating particularly high margins, but the corporate has high margins. And so you can say, well, what is that? Well, it's really because CAR is a finance company. The high margins come from AFC's contribution. So as a reminder, AFC's basically makes its money by lending to used car dealers to finance their inventory. So if I have, you know, a 40 car used car lot in West Los Angeles, and I want to buy a car from ADESA, I can finance it through AFC. And CAR makes a really nice margin on that because they're kind of the lender of last resort. But you know, finance companies don't trade at high multiples. I mean, just look at kind of the consumer subprime lenders like Ally Financial or Santander Consumer. Those things trade at less than 10 times earnings. So if you go and you put in, you know, you go to Capital IQ and Bloomberg and put in the comps for CAR, you'll probably see something like Copart or IAA or Ritchie Brothers, all of which trade at really nice multiples above 15 times EBITDA. But CAR is really a finance company, right? And you know, is not a comparable company to those great high margin, huge moat businesses, one of which they spun off, obviously. And so when you know, obviously there's a little bit, it's a little hard to know what the earnings power will be next year because of all the dynamics that Rob talked about. But at 7 and 9 times 2022 EBITDA, CAR is fairly valued. And then on top of that, you have the downside risk from the competitive threats.
Yeah, I think look, it's a somewhat valid point about AFC in that, and it's what's interesting is that no one really talks about AFC that much on the earnings calls and in the conferences. AFC, which again is their finance company, makes a lot of money. It's very high margin. It's a big part of CAR's profitability, and it's a very, very good business. And just a quick moment or two on how it works. It's, you know, basically you have the franchise car dealers, and then you have all the kind of next step down, and these are kind of Bob's car dealers, and they'll sell whatever on their lot. And you know, they've probably got, you know, one of those inflatable things flashing back and forth in front of their things saying like, buy now, we pay cash, all these things. And these guys, their primary source of supply on their lots is buying them from physical auctions. And when they buy them at ADESA auctions, CAR is right there willing to lend them money against that vehicle they just bought. And that vehicle is typically sold within 30 days. So that money's cycling really quickly. So you're not holding on to this thing for 5 or 10 years, hoping that the dealer's not going to screw you at the end. It's churning. And you're also lending against an asset that's not depreciating like a new vehicle does. So Ben talks about Ally as a comp. You know, Ally's lending to individual people who are buying new cars, and those cars are typically depreciating 20% the day they walk off the lot. That's a very different business. It's higher risk. You're more exposed to the consumer, and your loans aren't turning as quickly. AFC, totally different model, and you can see it in their returns. I mean, AFC has a a return on assets of call it 4%, depending how you look at it. By the same metric, Ally is 1%. It is a much better business. So it should be talked about more. It's not discussed enough in the car story. But if this were a standalone financial company, I think most people would talk about how impressive their ratios are and their returns on capital and their cash generation. What the multiple is on that, again, this goes back to the difficulty of valuing car. It's hard to figure out who are the right comps, who are the right comps for the auction business, who are the right comps for the finance business. There are no clear comps here. So to some degree, you have to figure out what feels right to you as an investor. And that's more challenging than just comping it against company A or company B. Just briefly touching on the upside from here, I talked about it a while back. Volumes have been crushed in the last year or so. That's a combination of COVID. That's a combination of used car prices rising. And just as a obvious example, there have been no repossession of vehicles as a major source of volume into the physical markets. And there have been no repossession of vehicles for the last year or so. And part of that is people not wanting to repossess vehicles during COVID and the optics of that. Part of that is that because used car vehicle valuations are so much higher than they have been historically, if someone can't make their car loans, they'll just sell it and maybe even make a profit on selling it. So repos just aren't happening. So a lot of these volumes are going to start coming back in the next year or two. And with cars' new cost structure that they brought in throughout COVID and took kind of hundreds of millions of expenses out, the margins are going to be higher. They could potentially have $600 million of EBITDA, which, depending on the multiple you use, could be $25, $30, $35 stock. And you're talking about a stock that's under $18 right now. I think what's another interesting point around that and the valuation and the upside is that during kind of peak COVID, these guys did a preferred stock deal with Apex Partners where they got $550 million of money from Apex via a convertible preferred that strikes at $17.75. So basically right where the stock is right now. Now, personally, I wish they hadn't done that deal. It's a little more expensive than I would have liked, but obviously those were scary times back in May 2020. So I don't want to second guess it too much. But the reality is you now have a large, smart, somewhat sharp-elbowed investor in there who's got a strike price at $17.75 and probably a private equity timeline. And I think you're going to expect them, if the stock's not performing in the next year or two, to be making moves to happen to make sure that they earn a return on the capital that they just invested.
No, that's a great point too. So we'll just go back and forth here with the parting shots, some takeaways. So from my perspective, what the bulls misunderstand is that the digital competitors are tech savvy, well-funded and scary, and they're going to continue to eat cars lunch in certain ways. The world is moving too fast for car to keep up. That's based on technology and culture. Physical auctions will decline and they will be a drag on margins over time. And it may be true that car will see a short-term bounce back as all of the dynamics that Rob discussed kind of clear up. That's already reflected in the stock price. And if there is a true secular decline here, it's not reflected.
Yeah, I'm just going to start with the last bullet point. You've got a new CEO who's bringing fresh perspectives and help changing the culture, and he's taking digital very seriously. He's got experience in that space. He was named the CEO for a reason. He's the guy to help car become a true omnichannel player. And I think what's kind of interesting is that a couple quarters ago, they talked about, physical auctions. They're over, everything's going to be digital. We're working that way. And they're actually now starting to explore opening physical auctions again. So to me, that just hammers home the omnichannel approach, how powerful it is. Obviously, there's still demand for physical auctions, and they have the ability to provide that. So they can do the digital, they can do the physical. They're there for however their customers want to move the vehicles. And they've got expertise in all those markets. And I don't think ACV has a special sauce. They are obviously aggressive. They're doing a good job. They're growing quickly. Time will tell to see whether they can make money or not, but I don't think they have anything in their quiver that car doesn't have the same thing. It doesn't have an ability to meet and compete. And I would make one last point. Ben and I could have flipped a coin on this presentation, and he could have argued the bull side and I could have argued the bear side. So the reason we're doing this, because it's fun for us to have this debate back and forth. And this is, again, this is a complicated, unclear opportunity here. And we obviously we both own it, but we both see the pros and cons very clearly.
So if you're interested in voting for who won this bull bear thing, you can contact Robert or myself. There's some contact information here for me, B. Claremon at Cove Street Capital. If you're interested in learning more about myself or a car, or of course our firm at Cove Street Capital. You can follow me on Twitter as well. I'm pretty active there. And then for the shameless podcast plug, if you're interested in a new podcast, just started the podcast Compounders, the anatomy of a multi-bagger. I interview public company CEOs about how they've built their business over time. And I actually just yesterday interviewed the executive chairman of CAR, Jim Hallett, about his journey and this company's journey from being a physical auction focused company to being more digital. So that interview will be released in a couple of weeks. And so if you're interested in CAR, that'll be a really good way to learn more about it. And Rob, you want to share your contact information?
Yeah, our Longnecker at Ides Capital. Happy to hear from you. Hopefully this was useful and interesting to you. I would definitely listen to Ben's podcast. He's great in his podcast. He's really thoughtful. He asks good questions, so it's worth your time.
We have a couple questions that came in through the chat box that maybe I'll pose the first one to Rob. So I think you kind of talked about this, but the trends and low inventories of used cars, is that a secular problem? Is it a cyclical problem? What happened? Isn't car right now just being left with the dregs that couldn't be sold on lot, and so you have a low value car that's not even going to get them particularly high fees? Is it, you think this is a permanent thing, or as you're saying, it's a just time will heal all wounds?
No, I mean, again, I'll go back to, I've been, one of the individuals that I've been talking to who does fleet management at a rental car company is basically saying we can't buy new cars right now. The inventory, the manufacturing agreements we have, they've been cut back. They're not supplying to us. We don't expect them to supply for the next 6 to 9 months. So everyone is scrambling for the vehicles that are left over. And there's no way that's a permanent thing. There's no way that eventually the chip shortage isn't going to get managed and the new car manufacturers are going to start getting supply into the marketplace again. So there's nothing secular that's changing in the used car market and where supply and demand is coming from. Repos are going to come back. Well, again, those rental car companies, they're going to start monetizing fleets again, which they haven't been doing. They've been holding on to their vehicles longer because they don't have replacements for them, so they have to do that. There's just, I don't know, I can't think of anything that would be secular in the supply and demand of used cars. I don't know if you feel otherwise, Ben.
No, I mean, I think the problem right now is it's really hard to know what volumes are going to look like, when they're going to come back, and that's why the stock is so difficult to analyze, right? If a car can get packed 2019 volumes in physical and have the digital opportunity on top of that, I mean, this is going to be a huge stock. Right? It's just, we are at literally the worst point in terms of visibility. And we all know that the market doesn't have a lot of patience for companies where they can't, where people can't just model out what the future is going to look like. So, I mean, that's why it's so interesting here, is because there's this wide cone of variability where you've got the competitors eating at them at one end, but also a huge D2D market and a potential rebound in volumes from physical auctions just based on normal new and used car volumes. And so this is why it's a battleground stock, and why Rob and I are both shareholders, because we think that it skews, despite my bear case, I mean, we think that it skews positive for car over the next few years.
Yeah, I mean, again, just you look at the cash flow of what they've done historically and the return of capital to shareholders. I mean, even if you think that's going to get haircut a little bit, and ACV is obviously going to take some share and maybe margins come down a little bit, it's so disproportionate to the current market cap of the company that you've just got a lot of margin of safety built into it.
That's fair.
And the only other thing I would say is if you've got a second car in your household that you're not sure whether you want to keep it or not, now's the time to sell it, because you can sell it for more than you paid for it a couple of years ago, which has never ever happened in the history of the used car market.
The next question we got is does Car expect to retain vehicles and attempt to sell them D2C like Carvana? You know, I'll answer that. I'm pretty close with the company, and I don't think that is on their roadmap. I think you have to take a step back and think of them as a supplier to a very large ecosystem. Not every car has the same, you know, no two transactions are exactly the same because every car is different. And so what you have to think about is that they're kind of a supplier to the Carvanas of the world and the CarMaxes of the world and the independent dealers and the franchise dealers. Because if you know anything about the dealer business, they don't make any money on new cars. New cars have very low margins. Where they make money are used cars and then parts and service. So that's where the dealers make money. So having a thriving used car business is actually a really important thing for dealers. And so, you know, Car is a kind of an arms dealer to that. So I don't see them competing with their customers. I don't think, you know, technologically, as we talked about, I don't think that's their core. For sure, Car Offer, which is owned by Car Gurus, is starting to do that. But I think when you have to zoom out and say, this is a 40 million car market. And so there can be new competitors coming up and new ways to source cars and people buying directly from consumer. And it doesn't necessarily impact Car. It's just that they will play in their lanes, and hopefully, you know, for shareholders, they will play really well in the dealer to dealer lane. And you know, I don't think they're going to be materially impacted by Rob and I going on CarMax's website and selling her directly, and as opposed to, you know, taking it to the dealer who could then, you know, sell it through an auction or to another dealer.
Yeah, I agree with that.
And so the last question we got, so more and more online used businesses are buying cars directly from consumers. And so this is kind of the same question. You know, it's a channel threat for sure. As I said, I don't think Car's going to get into buying directly from consumers. You know, the bear case is that someone develops this incredible technology where consumers, you know, just are totally okay with selling something that they may have paid $20, $30, $40, $50, $60,000 for online, sight unseen, you know, with no other transaction involved, right? Because you can imagine that you have to sell a car, well, then you have to, and if you need it, you have to go buy it. So simultaneously doing that together often makes sense, where you go to the dealer and you trade it in. So I don't want to completely dismiss the risk that auctions get disintermediated to some degree, either that's D2D auctions or physical auctions get disintermediated by a direct to consumer purchase model. It just seems to me a little far-fetched that such a large capital purchase is going to be, you're going to buy it like you buy toilet paper on Amazon, and you're going to, you know, you sell it like you sell an old baseball cards on eBay. I'm not sure that's the future. Rob, do you disagree with that?
Yeah, particularly because a lot of those physical auction cars, they're the older cars, they're higher mileage, they've got, you know, some sort of damage probably that needs to be fixed. You want to, you know, have someone check out the engine and then let you know how it's, you know, whether it seems like it's running well. There's just, you know, there's just a lot of potential potholes in that transaction. And then I just seems like hard to believe that a lot of consumers are going to sign up for that.
Well, that's the end of the questions. We had 3 really good questions. I think that's, you know, I think we'll wrap up here. You have our contact information if you want to contact either of us. Again, thanks Investor Summit and Fred Rockwell for having us on. And you know, we'll see you over the next 3 years. What I like about Car is that there's a great bull case, there's a great bear case. Time will tell. I don't think there's anything else that you can do right now. I don't think there's any amount of research that you can do. I don't think you can gain any kind of analytical edge. It just has to play out. And you know, having the right people involved is really important. I think the move to Peter Kelly, you know, as CEO has signified that Car has the right team in place.
Agreed. We'll see what happens.
All righty. Thanks
Good
for
luck to
having us.
both of us.
Yeah,
All right,
good luck.
thanks to Rob and Ben.